Hello, this is Pat Bautran. Today we talk about startup valuation in the age of AI abundance, how patents can shift the investor's supply-demand dynamics. Startup valuation has always been a delicate dance between supply and demand. Founders seek to maximize a company's worth, while investors aim to secure ownership at the lowest possible price. Traditional models hinge on metrics like revenue growth, market size, and team pedigree. But in today's innovation-driven economy, patents are rewriting the rules because vibe coding has enabled quick copying of concepts. By creating artificial scarcity and defensible moats in view of vibe coding, patents tilt the supply-demand balance in favor of founders, unlocking higher valuation and investor demand. And here's how intellectual property is becoming the ultimate leverage in startup financing. First, let's talk about the traditional supply-demand equation. In early-stage fundraising, valuation is less about intrinsic worth and more about perceived scarcity. You need to have a limited supply. Startups offer a finite equity pool, and you need to have high investor demand, driven by the fear of missing out or FOMO on disruptive ideas. This dynamic explains why AI startups with little revenue command billion-dollar valuations. Investors compete for limited access to transformative technology. However, without defensibility, this scarcity is fleeting. Copycats flood markets, demand evaporates, and valuations collapse. This is precisely the situation with vibe coding tool that can clone your idea in a matter of a month. How do you maintain defensibility in view of the fact that people can replicate your concept using AI coding tools? So, the solution is patent protection. How patents create artificial scarcity. Patents engineer scarcity by granting exclusive rights to innovations, transforming startups into singular investment opportunities. Consider the network effects. A patent-protected AI algorithm becomes more valuable as usage and user data grows, creating a feedback loop that the competitors can't replicate. Patents also provide legal monopolies. Patents block rivals from offering identical solutions. In the case of vibe coding, they can clone you very quickly, and thus the legal monopoly with the patent system forces investors to buy in or miss out on the idea. Data from PitchBook underscores this power. Startup with patents raise 73% more capital at early stages and secure 93% higher valuations at the angel stage. 58% of venture capital from 2011 to 2020 flow to the patent-holding startups. By legally restricting supply, patents amplify the demand and valuation for investors. And this holds true even if vibe coding becomes so easy that non-coders can outcode the coders. So, a landmark study of U.S. patent approvals revealed startups granted patents saw that the patents with startups have 55% faster employment growth, 80% higher sales growth, and 2 times the likelihood of going public. Now, of course, in today's startup rollover economy where even startups eat other startups and roll them all up, the value of the patent becomes even more important because when one company acquires another company in a merger and acquisition, the assets that they're buying becomes analyzed. And so in the case of a startup, what are they buying? They're not buying revenue because startups typically don't have a lot of revenue. They are buying the team, but the team could leave at any point in time and form another competitive solution. So the team isn't the way to go. They're really buying IP assets, the code, the patent protection behind the code. And that's why patents resolve investor uncertainty. They signal technical merits as vetted by the patent offices and provide collateral for loans. So for inexperienced founders or startups outside of tech hubs, patent can act as a credibility substitute, attracting capital that might otherwise flow to safer bets with bigger brand names. Let's look at patent as a defensible moat. Investors increasingly prioritize startups with unfair advantages. And in the days of vibe coding, unfair advantages is a diminishing asset. Anybody with coding tool can aim that at your website and copy your ideas. Now, patents can provide you with unfair advantages, and they deliver this by number one, blocking competitors, number two, enable premium pricing, which flows down to your EBITDA, which means that the higher the EBITDA, the higher the valuation of the company. And it also unlocks non-dilutive revenue such as licensing arrangements to non-competitive industries. So what are the strategies to maximize the patent leverage? First, you got to file early and file broadly. You can use a combination of provisional and non-provisional. And you can also use the Patent Cooperation Treaty to secure international protection. Second, you need to prioritize high-impact claims. Focus on the core innovation, the technical workflows and the AI training and data AI pipelines, and how your solution can use all of that in applying the AI to provide a more accurate solution or a better solution for the customers. You should also consider the hybrid system where you combine specialized hardware with specialized software. So for example, if you're building a humanoid, that's a perfect example of custom hardware and custom AI software. Number three, you weaponize patents in negotiations. Startup with patents secure a 28% higher pre-money valuation in VC deals. You can use your IP to demand favorable term and to structure an earnout tied to the patent commercialization. Number four, you globalize and layer your protection. So first of all, you file in where you manufacture. So for example, China for electronics, and let's say in the US for software, in Europe for the business models, for example. And you can pair your patents with trade secrets, trademarks, and copyright protection. So you have a layer, and you should have a portfolio, because as in investing, you don't want all your money tied up in one stock. You want your assets in a rich portfolio of different categories of assets. So in the future, patents as currency. As AI democratizes innovation, patents will define winners in crowded markets. Startups that patent early and strategically can attract the acqui-hire deals, where the tech giants pay premiums for patent. You can build an ecosystem. So you can use your patent as a source to encourage industry adoption and cement your leadership. And you can also use AI patents to navigate the regulatory issues such as compliance risk by applying your AI to deal with bias and risk mitigation. So in conclusion, scarcity is a choice by founders. In traditional markets, scarcity is accidental, but startups, patents make it intentional. By legally restricting supply and amplifying the demand, IP transforms startups into must-have assets as proven by data and the exits. As one VC noted, in a world of copycats, patents are your monopoly money. For founders, the lesson is clear. Don't just build a product. Build a product with a great moat, and patents should be part of that arsenal. If you have any questions, please feel free to contact us.